All right. What's up, everybody? And welcome to this special webinar, Unique Approach to Oversized Options Profits, Profiting from Unusual Options Activity. I'm really excited. We have Tim Biggam here. Tim has a storied options history. He's a pro's pro. When I very first got into this industry, you were like the secret guy behind the hot product. Like they had you were the one who created the trades. It was this amazing marketing thing, but they had you doing the trades. You were the head of options education at Thinkorswim, and I think as most traders will respect, that stopped because you didn't want to not be able to trade. And you've been doing it for a long time. You've been doing it with us for a long time, but we have not had a chance to introduce you to a new audience because the companies were getting bought and sold. Politics. It's politics, but it's been like, it feels like years since we've been on a webinar. And I love your approach to options because it's different than everybody else's and it's built to win. And you've been doing great for a long time. So you guys are in for a treat. You're going to learn a very specific skill, and it's pretty much, I don't see many people at all who teach it the way you do, Tim. I think it's very unique, and that's where your edge is. You know, people ask, what's your unique edge? You're going to find it right now. So, Tim, good to be with you again after a while, and I very much am excited for you to introduce everybody to the strategy. Just real quick, I like to get the charts going, and I know it takes a second because there's a little bit of a lag in the comments, but we feed off your energy. So if you just want to say hello, or one if it's your first time meeting Tim, but you guys are all in for a treat today. But get the chats going. We like to see it. I know it takes a couple minutes. I don't know why. We got to work on that lag. But yeah, we're not going to wait for them to come in because it's going to be like 100 seconds before we see them. But Tim, floor is yours.
Appreciate it. Thank you, Em. It has been a long time. I actually put on the old Option Cobra sweatshirt from days of yore. So certainly, and it's glad to see you guys, where you're at again after a few months, let's say, of turmoil, but getting things back to where they should be, which is great. So as you alluded to, I've been trading options forever. We'll probably go out, feet first trading options, which I think really is great. And part of the thing, besides obviously giving profitable trade ideas and some decent content, is to give people, and that's what I found out with my Cobra people who've been with me for years, they take kind of what they've learned from the Option Cobra program and use it in their own trades. They will kind of take a slightly different approach, maybe to even some of the trades I recommend. They would say, hey, I like this, but I did this, and I think it's absolutely great. So getting the ability to kind of use option knowledge that you gain from the Cobra and take it into your own trading, I think is the most kind of underrated, aspect of certainly this trade advisory program. So I'm very happy to do that, kind of pay it forward. That's how I learned, my option skills was years ago on the trading floor as a runner. Friend of my dad was a trader. He taught me the ropes. So I kind of look at this as a similar sort of process as well.
Awesome. Well, yeah, I'm excited for everyone to learn it. And yeah, and then we'll stick around for any questions you may have. I see some people chatted in. Robert, Cat, it starts. Some people have some fun names on there, but yeah, please use the chat. We'd like to hear from you, and yeah, take it away, Tim.
Yeah, no problem at all. No, I love unusual options activity certainly has come to the forefront over the past 4 or 5 years. In a big way. And it's really simply everyone just follows the big option orders and tries to tag along with them, which sometimes may work okay. But most of the time, really what you're doing at the end of the day is overpaying dramatically for those options, because usually the big order gets things going. People then, after that, climb on board, drive the price of that particular option even higher. And you end up kind of way overpaying for those options. So we like to take advantage of that sort of mentality in a way. We're more than happy to sell what everyone else is buying in essence, and then hedge or position similarly with something that hasn't been, raced up to the moon. So we have that very nice kind of vol edge going into the trade to begin with. And then we usually lean a little bit with the order flow because sometimes they're right, many times they're absolutely wrong, and take advantage of that way. So we always like to put the odds in our favor. And at the end of the day, and you'll hear it from me probably too much, trading is all about probability and not certainty. And, implied volatility, right, is really just a measure of probability as well. When you look at like the delta on an options, it's the probability and so forth. So I think understanding that is the key really to understanding options. So let's jump in and start this thing going. So here's a quick bio of me. As Adam kind of hinted at, I was back at Thinkorswim 20 years ago now as lead option strategist, helping people educate, traded, for people managed accounts, have appeared on TV forever now, right? I'm still on the Schwab Network every Tuesday, and they kind of give me a trade topic. I come up with a trade idea. That's kind of, we'll talk about the end of this presentation. You get a bonus trade out of that as a co-subscriber. So enjoyed doing that immensely. I was on the trading floor, started as a runner, went to a market maker. Then when things changed, as always, headed upstairs, started working, managing other people's money, ran a little hedge fund for a while, which we never got to the dollar amount that you really need to get to make it viable with all the costs, right? Things have changed since then, right? Costs have come way down. But back then, the cost to even run the fund kind of outweighed it unless you had pretty much a 9-figure fund. So my driving, goal really is to pass my passion and knowledge of options and trading and stock markets along to new and even more experienced traders. I think that's, getting excited about trading, getting up every day, enjoying going in front of the screen, I think is what really drives that trading passion, which really takes you through and you can really stick with things longer. So enough about me. Let's get into what unusual option activity is. It's really a high volume of specific options that are much bigger than the normal amount of trades. Like Apple or Tesla or Nvidia trade a ton of options, right? It'd be rare to see unusual option activity there. But in this case, you're looking for kind of those mid-tier names. I'd say, the 100 to 400 in the S&P 500 as far as market cap is where most of the trade ideas are generated from in unusual option activity. Those stocks have enough liquidity, right? Because you don't want to get into the Roach Motel where all of a sudden you can get in okay, but God bless you getting out. But those names tend to have enough liquidity so you have no problem doing the trade, both on entry and on exit. The other thing we always look at with unusual option activity to see is that the volume exceeds the previous open interest. That way you can tell it's fresh, new buying, right? Many times we'll be buying to close an option, where if there was, a huge order from earlier, they might be buying to close the order they sold earlier. So when it exceeds what's called the open interest, that's fresh, new buying. You want to make sure it's taking place basically on the offer, right? They're paying up to get into the trade. They're really aggressively buying these options. The implied volatility will lift on this. That's really what we feast on as well. And it really indicates that there might be someone who knows a little something positioning with options because of the leverage, right? To get into a position where if that knowledge comes to fruition, they can have a very big profit. I would say sometimes, not many a times, that is the case. Many times it's just guys using their, big pockets, right? They're hedge fund guys who have a lot of money, right? And they don't mind spending a couple $100,000 to buy a bunch of options and hope they're right. Sometimes they are, most of the time they're not. But we'll take advantage of them overpaying nonetheless. And it's even more powerful when you see that repeat buying, right? Someone wants to kind of build a position. That really means they probably know something. So, the hardest thing sometimes is to find that unusual option activity, make sure it's bona fide. So I have built and I use different option scanning technologies out there. There's one on Thinkorswim I use day in and day out, the desktop platform. I've built a option scanner on there that certainly I've shared in the past with all the Cobra people. Be happy to share again. Very simple, but it's a pretty effective tool to use to identify unusual option activity, kind of broaden the universe. Then I do pay for some more kind of higher end unusual option scanners out there, and that I use as far as identifying Cobra trades as well. So indirectly, you get to use that scanner as well. And the key with option activity is the unusual kind is you always want to take a look at implied volatility. Has that option moved a lot, right? And that's really the key to it, right? So I always scan for big order flow that's unusual and has moved the implied volatility. Implied volatility is just a fancy way to say the price of the option. So these guys are coming in, they don't care really what they're paying. We're more than happy to sell that option to them and then hedge and buy something that really hasn't been bid up like the ones that everyone's jumping into. So everyone's jumping into one pool. We'll kind of take advantage of that and just go in the other pool where no one's at. And that's really the key to it, is to capture that probabilistic volatility edge to begin with, right? And then usually lean slightly with the order flow. Most of the time it's going to be call volume, right? Because buying puts even to open for the big boys is a lot of times putting a floor in on the stock. So it's not nearly as informative as fresh new call buying, because that's a way to kind of pre-position, right, for a move in the underlying stock. And as I said earlier, trading is all about probability, not certainty. Sometimes it's going to work, sometimes not. Make sure the times when it's not, the losses are manageable, right? I always say too, losses are inevitable. Large losses are unconscionable. So make sure that you know where to get out before you start getting into a trade. So what is IV? This is the key, really, I think, to the Cobra. And, what separates us from most of the other option, trading services, especially unusual option activity trading programs out there, we focus really hard on implied volatility. I trade it day in and day out. I do a lot of relative implied volatility trading on my own and for my managed accounts. I bring that same mentality into the option Cobra. So the one thing, higher IV means higher price. IV is, in essence, the price of the option. Large option buyers, right, usually drive IV higher, usually drive up the price of the options, right? It means that the option prices are much more expensive than they really should be because of that option buying. This favors selling those options, right? Not tagging along and hoping they're right and you get a massive move from there, right? And hedging, right? Taking another similar position in much more fairly valued options, right? And then wait for things to realign, as they always do, because IV is what's called mean reverting. It's probably the most mean reverting, financial thing out there. If you look at the VIX, for example, right, you will see quick spikes, right? But it almost always lasts for a very short period of time. So here's that option scanner on the Thinkorswim platform. Again, be happy to send this out to any of the new subscribers out there. Super easy to build, but it identifies basically unusual option activity that has moved the implied volatility surface. And that's the key. In other words, the price of the options has gone higher because of this option buying. If it hasn't gone up much, right, you're not going to capture that vol edge. So here's a particular one, actual trade we did a while back on Mired, MAC. You can see it hit up on the option scanner. You can see here was 8,800 contracts traded. That was what we saw on the scanner there versus just 3 open interest. Now, that is probably, not seen too often, right? Normally you'll see, hey, 4,000 contracts traded versus 1,200 open interest, something of that nature. This one certainly is the poster child of unusual option activity exceeding open interest in a huge way, right? Doesn't get much more dramatic than this. So no one really had any position. Then someone decided, hey, we'll go out and buy damn near 9,000 of these. You can see what happened to the implied volatility. Here it is before that big call buying stepped in, right? You can see the implied volatility of that particular option trading just under 100 at 96.14. And again, implied volatility is the price of the option. Then the day of that big call buying, here's that 8,800. IV jumps to 115, right? The stock goes down, right? But these options actually go up in price simply because of that call buying out there. This is what we look for day in and day out to set up a trade to capture that implied volatility and lean bullishly with that order flow out there. So to summarize it really quickly, the IV jumped from under 100, was around 96, to 115 due to that big call buyer out there. Stock price actually dropped 5 cents, and for a $9 stock, give or take, that's not a minuscule drop, right? But the calls increased 20 cents, right? So this favors selling those comparatively expensive options, certainly when constructing the trades. And there's many ways to go about doing it as well. So here you can see on a chart what happens. Here is that day of that big call buyer. You can see IV, and I pulled it off, right? This is an IV reading. You can see IV just explodes higher. And then once that buyer steps away, right, it reverts back as always to pretty much towards the level it was before. So that big UA call buying creates that huge pop, right? Once the buyer steps away, you get that big drop. So we look to sell the rip and then buy the dip in essence. So how do we go about doing that? Many ways to do it, right? Call calendars, certainly, where you're buying a little further out option of the same strike. Selling the one option that they're all buying out there has certainly been a trade structure we employ a lot. Call diagonals if we're a little more bullish, right, on the underlying stock. We might buy a slightly more in the money call further out than the one we're selling. Or conversely, if we're a little more bearish, maybe we'd buy slightly further out on the one we're buying as far as out of the money versus the one we're selling. But basically using that kind of time spread, calendar spread, methodology to capture that big order flow, but lean bullishly. We're usually a few deltas net long with a call buyer out there net with the trade initially. So in case there is something viable about why they're buying these, we won't get hurt by a big move. Also, if the implied volatility lifts everywhere, which sometimes you see, right? It not only lifts this week's or this month's that they're buying, it lifts all the back months where normally we look to hedge. We might just simply sell a bullish put spread, right? We've done that a bunch of times where we've seen the put spread actually go up in price, right? Because of the call buyer, because of put call parity. With the stock really going nowhere, all of a sudden the put spread's more expensive. We want to lean bullishly. We'll sell a bullish out of the money put spread to capture that kind of unusual option activity that way. And then a buy right, which in the case of MAC, right, was trading under $9, right, a cheap stock. We'll simply buy the stock, sell that very expensive call right, in essence, get into that buy right for cheaper. So many ways to go about doing it. And we certainly have taken advantage of all those ways over I think it's been almost 5 years, maybe even more, that we've been trading the option Cobra. So here's a recent somewhat trade example that came out, an actual trade example on ASTS. And you'll get this here where there's a quick summary to start with, right? A quick explanation. I followed up with a trade video, right? A trade walkthrough video where I go more in depth on why the trade was done. But initially, just maybe a short paragraph on why we're doing this trade and what the IV effect is and everything. So here, ASTS has continued seeing huge option volume. IV now at the highest readings of the year Well, shares are finally beginning to slow down after a monster rally. So we had this kind of on the radar, but we didn't jump in right away because we saw ASTS continue to climb the stock price. We saw the volume continue to come in. So you don't want to jump in front of the horse too soon on this. So in this instance, we took advantage. The vol lifted everywhere, right? We sold an iron condor trade, right, to take advantage of it. Sold an out of the money call spread that had gone up in price big time, out of the money put spread that hadn't fallen in price at all, right? And sold that for 75 cents net credit. It expired fairly soon. You can see it was August 27th. This was September 20th. Both of these were well out of the money. Plus, you had a 20-point wide P&L area on this iron condor, right? The $20 put was our short strike. $40 call was our short strike. Wasn't earnings related or anything. It was just this huge lift in IV. So this set up ideally for both a bearish call spread and a bullish put spread, both, which is the iron condor trade. Capture vol on both sides, take a somewhat neutral approach to the trade. You can see here's the day we did the trade, and there's the actual price, right? That was trading about 77 cents. And I will always send out the alert, once the trade has been done. I kind of do 1, 2, 3 contracts in my own account. Once it fills at that price, right? I kind of know, okay, this is doable now. Then I send out the alert so it is a actionable trade instead of just putting out something that no one has a chance of filling and claiming it was done. These can all be done. And usually I give a little bit of discretion in case the stock moves or you're maybe a little bit late to the trade. So this one we were able to sell at 75 cents to capture that huge jump in implied volatility. Here you can see it started to climb and then you get this huge rip higher, right? So this is pretty much our core strategy in the Cobra, which is UOA based, is to sell that rip and then cover by buying the dip. That's that mean reversion, right? So we make as much usually, if not more, off just that mean reversion aspect, as much as maybe capturing a little, bullish lean with some big call buyers out there. So, but this is exactly what we look for. Huge spikes in implied volatility caused by huge option repeat call buying, right? And normally if stocks go up, implied volatility should drop, right? You look at the VIX, usually drops if the market rallies and vice versa. Here you're getting the counterintuitive effect. You got someone who is just willing to pay almost anything for these shorter term calls, will sell those. In this case, it lifted the IV everywhere, so we did that iron condor. Then you can see a couple weeks later, we covered this trade for under 30 cents because that IV had flattened, right? So in essence, we sold it up here. Once IV dropped, right, we were able to cover the trade for a very nice gain. So a fairly neutral trade, right, with limited risk, 2.5 points wide on either side, right, selling it for 75 cents. So $1.75 total risk, right, because only one side can get in trouble. We did it 4 times. And normally our trade, I'll always give a contract amount. The risk is usually around $500 to $700 per trade. So you can size up according to kind of your account size, how much you want to risk on the trade. But here we covered it at 28 cents for a very nice gain of $168 or 24% return on risk for a fairly neutral trade in basically a 2-week period with the stock going nowhere. So the nice thing about options, unlike any other instrument, you can get money for nothing, I call it. If nothing happens, you can construct really a trade in options that benefits from that. And I think we're entering into a market environment where that's starting to look like the case. Certainly the S&P, that 6,000 level, looks like it may hang around for a while without much of a move one way or the other. We shall see. So here is here's the actual entry. You can see you certainly could get in for 75 cents. Close out trading 27 cents. We said 28. So absolutely, again, an actionable trade. And then occasionally we'll do a put sort of trade. This one was on GameStop back in the day where we just saw this, enormous sort of short-term option buying, right, drove the IV off the charts here. So we just took advantage on May the 14th, right, did a kind of, bearish put diagonal, right? The stock had ripped higher, right? We wanted to lean a little bit bearishly, but take advantage of that massive IV on the shorter term. So we bought the traditional June 28 put and then sold the shorter term where everyone was buying, right? May 17th expiration 25 put, paid $4.50 for that trade. Then lo and behold, the next day, right, IV flattened. And that's how fast it can happen sometimes. So we were able to take advantage of that IV reversion, had 1 day of decay, which normally isn't a big thing. But when you're looking at IVs off the chart, time decay theta becomes actually bigger, especially on the ones they're buying. So we have a edge on time decay as well by doing this sort of trade structure. So this one we closed out the next day, made a very nice gain of $180 or about 40% in 1 day for having a fairly much hedged trade on this, more of a vol capture trade as anything else. We've been recently kind of looking to add some new stuff to the UOA, approach, which I think is absolutely, something that people have been very, kind of like, hey, even more stuff. Yep, that's what we're doing. So I've been doing some pairs trading, right? Especially in this market environment as we stall out, which is, kind of buying the underperformer, selling the outperformer, if you will. Buying Target, selling Walmart recently, right? Target's been throttled into submission. Walmart went off the charts. Recently, that started to realign. But we actually did a trade not too long ago on Apple and the triple Qs, right? That certainly made a lot of sense. So we can walk through that. So we basically take a bullish stance on the big underperformer, take a bearish stance on the big outperformer. The two have to be, pretty highly correlated. Otherwise, it doesn't make sense, right? And we look for basically that reversion to the mean, right? In this case, not from an IV standpoint, but from a price standpoint. And then we take the trade off to hopefully make some profit. But we have a fairly neutral trade at inception. So here is what we are looking at. It kind of gave us the initial trade idea. Here's Apple versus the triple Q. And as you can see here, Apple, which is in blue here, had just started to get absolutely hammered, right? Triple Qs were breaking towards their, all-time highs. That spread, which normally is very highly correlated, right? Apple, the biggest component of the triple Qs, right, should be highly correlated, right? But it had gotten to 10 points or 10% differential, right? The Qs had gone up sharply. Apple had been downtrodden, so that makes that divergence even more meaningful. So we just put on a trade basically shorting the triple Qs, buying Apple, looking for that spread to converge, right? Doing it in a defined risk fashion as well. We're not just going out shorting triple Q stock, buying Apple stock, because number one, that can be expensive. And two, you don't know if it's going to widen out even more, right? Because again, trading is about probability, not certainty. So here was the actual trade that came out January 22nd. So not too long ago. Apple down a little today, while triple Q is higher again, right? Apple been a huge underperformer over the last few weeks, even though it's the largest weighting by far in the triple Q. Position for a convergence trade, look for that to come back in line, with Apple being the outperformer, had been the big underperformer over the coming few weeks. So in essence, we sold a bullish put spread on Apple, right? Out of the money put spread, sold the 210, 207.5 put spread for 50 cents. And at the same time, bought a bearish put spread on the triple Qs, bought the 520 puts, sold the 518, paid about 50 cents for the trade. So doing it for pretty much even, right? But defined risk, 2.5 point max risk here, whatever you pay for it here. What we're receiving is pretty much what we're paying for it. So did it for even money. Our max potential loss, right, would be that $250, right, if Apple got downtrodden here. And you can see here's the actual fills getting filled at 50 cents on that Apple put spread up here. paying 48 cents on that bearish triple Q put spread here. You can also see the IV difference. Apple, we're selling a 30 IV. Apple was trading at about the 70th percentile on IV because of the big drop recently, and triple Q buying under an 18 IV. That was trading under the 20th percentile because triple Q was near the highs. So we like that as well, right? Buying cheap vol, selling expensive vol. Lo and behold, we finally get that reversion in a big way, right? It was on the Deep Seek day, right, where triple Q getting clobbered, right, with the AI news out of China, right? Apple was actually higher that day. Spread has definitely converged. So we elected to get out of the triple Q put spread that we got into for just under 50 cents for over $1. So made a very nice quick 100% gain on that one, or a little bit over 50 cents. Then we said Apple is near the highs of the day, right? Earnings on deck later. Let's close that Apple put spread out. Maybe no need to, right? But let's just err on the side of caution. Covered the Apple put spread for 25 cents. We sold that for 50. So made 25 cents on Apple, all because of that convergence. Made on the triple Q, the bearish side, made on Apple, the bullish side. So made on both sides on this. Here you can see how that spread converged. Here's where we put it on, where it was trading at a 10% differential, right? And now you can see it narrowed. Triple Q got hammered. Apple actually rallied. Spread converged to only 6% discount, enough to certainly make a very nice profit. So walking through it quickly, made $75 overall on Apple, right? Because of the contract amounts doing 3 times, right? 3 times that $25 gain. Same thing on the triple Qs. So total gain on the trade, $240. Total margin requirement, it was just that Apple put spread of $750, 2.5 point wide, 3 times, right? So percentage gain, 32%. Holding period, just 5 days on a fairly neutral trade, right? Being long Apple with a bearish, sort of put spread, right? A bull put spread, if you will, selling that put spread, and being bearish on the triple Qs by selling that call spread. So that's what we're going to kind of be focusing on. Probably a little more here is these kind of defined risk pairs trades, because I think the market overall is probably going to enter into, at best, a consolidative period. 6,000 on the S&P, 540 on the triple Q. Looks like a triple top now. But the market might have trouble moving appreciably higher here, simply because valuations still stretched even after the sell-off. Interest rates have come down, but not sharply. They're still near the highs of the past 5 years or so. So I think the market will have trouble moving higher on any more multiple expansion. And earnings have been good, not great. So it should be a time where the market may have that big range, no change sort of environment, which actually feeds into this sort of trading philosophy, as well as the unusual option activity approach as well. Then finally, what I do every Tuesday, I appear on the Schwab Network a little bit after 10 o'clock Eastern time. They give me the topic. I come up with the trade idea. It's a bonus trade. It's almost always implied volatility based, right? And it's very kind of low risk, low cost, and so forth. And so far, so good. It's been performing well. This they don't include in the track record. It's kind of the bonus trade. But if anyone wants to kind of play, usually an earnings play, because I avoid earnings normally or event risk in the regular Cobra trades. If there's a reason someone is buying a bunch of these because of earnings or something, I tend to shy away from that. But here, this is a way for people who like to kind of play that to do it on their own. And so every Tuesday, I'm on the Schwab Network talking a trade. So here's the most recent one. It actually came out yesterday on Kava, right? Kava came out with earnings after the close yesterday, selling the 95.93 put spread for 55 cents. Most people got more than that because Kava was trading over 100 when I was on TV. It dropped briefly to 99. Kava, last I looked, was trading right around 100 as well, post earnings that were kind of a miss, but then the guidance and so forth was kind of good. And Kava had been beaten up so bad that I just kind of said, you know what, this thing is maybe getting a little bit overdone, but regardless, define risk, right? 2-point wide spread, bringing in 55 cents. So in essence, you're risking $1.50 to maybe make 50 cents, but you have about a 10-point downside cushion when the trade came on. So here was the actual alert that came out. Kava reports earnings after the close today. Options implying a 12% move. That's based on the straddle price on the Feb 28th options, right? Stock definitely oversold. I mean, hugely oversold on a technical basis. There was previous downside gap support on the chart 2 earnings ago at the 98 level. So I kind of like that 95 strike price for that region as well. It aligned with that kind of expected, downside move boundary too. So here was the trade buying the 93 put, selling the 95 put for a 55 cent net credit. Nice return on risk of about 38%. And again, this is kind of the bonus trade. So this is something we've been doing, I think, for probably about 1.5 years now, since I've been doing the Schwab Network, is just giving these out to the crowd as well. So that's pretty much it for the walkthrough of the Cobra. I'll welcome your questions. And Adam or Patrick, if you're ready to take over from here, we can call it a day on the explanation part.
Thanks, Tim. That was a great summary. And what I'm really good at is taking something and really making it simple. And this is what I want you all to understand about what Tim went over. And like with me, the more I listened to him, the more sense it made. And it's this: everybody else out there who doesn't have a good track record and doesn't do well emphasizes the importance of buying unusual options activity. But most of the time when you do that, you're wrong. Would you all agree with that? And I think you would. And how many of you have ever signed up for a different service? You know who the names are, you know who the players are. I've worked with all of them, where they're like, oh, this has unusual options. This has unusual options. Buy it. And you just get killed. You're just chasing it. You're chasing your tail. How many of you ever had that experience? This is the opposite. It's identifying that most of those calls are wrong. But we would never naked sell short. So every time there's an overinflated option, Tim's popping that bubble. But just in case there's any truth to the rumor, he's buying that longer dated call or put, usually call, right? So as an example, let's say you have an overinflated calls shooting up for March. So he's going to sell the overinflated March and buy the April. So what happens is, even if it really was the real deal, you're still protected because you have the longer dated calls, which will always carry more weight. But most of the time, what you're getting is reversion to the mean. So it's a very conservative, high probability pro strategy. And I just want you to know, when we're selling those options, you're never naked. There's never a chance you'll be naked short or anything like that. You're selling the premium, but you're buying the calls behind it, so you're completely protected. Let me know if you all understand that, because it really is an amazing formula that's identified some really good trades. And the best part about it, besides the long-running and successful track record, the best part about it is that it's going to be market agnostic, which means with these kind of plays, they won't be influenced by whether the market is going up or down. Like if you're in one of these trades, you're not going to lose sleep over whether NVIDIA's earnings will impact this. Does that make sense? So Tim is awesome. I'm so psyched to have connected with him, and we've now been working together for, we're almost at I don't know, is it almost 10 years? I got to figure it out, but it's great.
Been a long time for sure. Yeah.
Right. It's been a long time, and you look great, by the way. You look younger now than when you started. Maybe it's the shorter haircut, but you look good. But Tim, you do a great job, and I love being connected to you, and I really feel like with you, with this service, it really is truly a professional service. And with that said, it's like, all right, maybe I drink Starbucks. Maybe you guys don't like to overpay for Starbucks, but it's literally one overpriced coffee a week to get this. $1.99 for 3 months is crazy. And when you go to this page and you look at it, and everyone should go now to the link, adameshlive.com/Cobra, you'll see that you get trades every week. You get strategy sessions with trade targets every week. You get a dedicated email alerts with clear instructions on every trade, entry, exit, and strategy breakdown. And also there's premium support. So it's consistent. You get it every week. They're great ideas and they're market agnostic. So if you're someone who's sitting around feeling like, oh, I'm always wrong on the market. I'm always a step behind, right? What this does is it says to you, no, you're good now. Just these trades won't do what the market's doing. They're going to do their own thing, and they get the mean reversion. So even if you're nervous, you could try it. You can start small, and then you could take it from there. But it's a skill and something that I think you're going to be using forever. The price doesn't go up after 3 months. There is no more expensive price. It's $1.99 for 3 months. Come and go as you like. But I encourage everyone who's on here to try it and trade it today. I mean, you'll love it. You really will. So go to adamesh.com/Cobra, and we'll get into it from there. Meanwhile, Tim, just on a separate note, market having a big reversal today, huh?
It's, I think we're finally getting a little comeuppance on the Momo names, right? Certainly we've seen that were just going up because they were going up and valuations be damned. So we're finally seeing value outperform growth, and how long lasting that is remains to be seen. But I think we're going to be what I call mired in the muck here around 6,000 on the S&P for a while. Those old highs may be tough to pierce through, but there's really no concerted, bailout yet. It might come, but earnings season kind of coming to an end. We'll see what NVIDIA does after the bell. Earnings have been good, not great. Revenues coming in kind of light. So we're seeing company margin expansion. We're seeing multiple expansion on stocks that the S&P 500 price to sales ratio over 3, still the highest level ever. So stocks are not cheap. A lot of faith in AI and growth, we'll see. But as we always know, trees don't grow to the sky forever. So I think we'll be kind of sideways with the Fed, not cutting as aggressively as they were hoped for initially. So it's just a market that I think will be more of a stock pickers market. And I think that lends itself to, kind of the philosophy we embody, which is take advantage of opportunities when they're there and do it in a reasonable fashion. The days of just jumping in and riding the wave, I think, are coming to an end.
Yeah. I prefer not to be able. I prefer the days of jumping in and riding the wave coming to an end. I like action. I like volatility. I like back and forth opportunities. I know you do too as a trader. So these kind of markets is what gets me excited, because things are in motion, and the motion creates the opportunities for the real traders, which is great. So if you are on here, I really strongly encourage you, go to adamesh.com/Cobra. Sign up now. It's $1.99 for 3 months, right? We're very easy. If you don't like it, we'll give you a refund. Price never goes up. But more importantly, for anyone who comes on today before 2 o'clock in the next 9 minutes, so just to put you to the decision, I have another special surprise. Let's just say it that way. And everyone knows my surprises are good.
They are. I'm wearing one of the
one time it was Options Cobra sweatshirt sent out to all the buyers. But I have a really cool surprise for everyone. If you have any questions, certainly let us know. But this is gonna be good. You're gonna be in it for the long haul. It's something you're gonna use and really appreciate in your trading, for sure. Okay, and then any other questions that you guys have or anything like that? Certainly want to make sure that if you have questions, we answer them, and go from there.
I did see one going back. Mario asked how to justify if option is expensive. That's where implied volatility comes in. So when you see, as we did in the example on MAC, the implied volatility jump that big, basically the option went up in price with the stock going down a little, and it wasn't earnings or anything else related. It was just based on order flow. Then you kind of know that option is expensive, right? And you saw how quickly that option reverted right after that buying dried up.
All right. And by the way, that cash register rigging is not cash coming into a register. It's actually what the sound of my computer when a trade goes off. I have that for fun, Tim. That
I like it. Ring the register, yeah.
Yeah, I said it. It was like a new feature that Tasty Trade added, and I'm a fan of it.
Absolutely. Does it give sad trombone if it's not a winning trade? Or
I mean, I think we need something when I'm buying too, but it's just
yeah.
No, this wasn't puts before this call because the market just started dropping.
Yeah.
But all right. Any final questions? Mario, Daniel, ask good ones. Gene, Robert, Kat, or any of the people that have funny nicknames that I don't feel right saying, like 2DTH and stuff like that. But yeah, okay. So Carl's in. Carl, I'll follow up, and I'm going to tell you about what you're going to get. That's going to be cool. 6 more minutes, Tim. I'm doing a hard deadline for this surprise.
Okay, no problem.
But it will be cool. Listen, because the thing is, like, anyone can sign up whenever they want. You've been doing this service for 10 years. We have a lot of great members in it. But I always like people to make decisions. And so if you're on this call and you're like, I'll do it later, the benefit of doing now is I do have a surprise for everyone. So happy to do that. And again, I really am a big fan of what you do. I take a lot of pride in the fact that I work with you, and you're really just a pro's pro of options trading, which is great.
Yeah, and I mean, working with you guys from day one, the reason we kind of got together, I think, is because we were both different than the usual stuff you see in, the kind of trade advisory world, right? Being upfront, honest, and, being okay with telling it like it is, right? Too many, on both sides of our fences here tend to, embellish without, ever wanting to hint at what actually happened. I'm always going to be, and I know you will too, very upfront. Here's what happened, and you got to take the occasional bad with the good. Luckily, from day one, we're still doing good and hope to continue. And having that edge where you can sell expensive and buy fairly valued over the long haul, it's like being a market maker on the floor, right? Does every trade work out? No, of course not. But the key is over the long haul, as Paul Newman said in The Color of Money, hold my own and some of theirs. That's what we look to accomplish here as well.
Meanwhile, just fun last game for you as we have a couple minutes real quick. Without looking, the daily on the Qs. The Qs are trading at 512.50 now. I think it's factoring in a little bit NVIDIA after hours because the Qs could trade till 4:15. So we'll have an extra 15 minutes where that earnings will impact these options. But the 507s, 5 points lower today. What do you think they're trading for now?
The ones that expired today?
Yeah.
The 507 puts? Oh, geez. I'm going to guess 65.
57. Very good. Very good. That was close. That's a lot higher than I would have thought. I was looking to buy some cheap options in case the market wanted to unravel a little bit right now. But they don't exist.
Yeah, we had the big spike in VIX too, along with NVIDIA having a big impact on the Qs. And a lot of guys will be doing, we talked about the, pairs trade. a lot of guys will be trading NVIDIA versus the Qs because NVIDIA is what I think number 2 now in the triple Q weighting. It's 2 or 3. It's certainly one of the big boys. So there's some definite correlation. So a lot of guys are doing, dispersion trades between Qs and NVIDIA.
Do you think we could have a real market sell-off?
We need it.
No, before. Do you think that could happen today before the NVIDIA, or you would need NVIDIA?
I don't think before NVIDIA because, God forbid, you have to explain to your risk manager why you got massively short the Qs in front of NVIDIA earnings, which saved the world. So, no big boys are going to be taking that thing, but we need, if you look at the S&P chart, right, there's a trend line that has been in place for a year and a half that hasn't been pierced outside of Valmageddon Part 2 last August. It finally broke a little bit. So, this has been going on way too long than normal. So when it happens, it might be ugly. The question is, when will that happen? I don't think we're going to head much higher, but I think it might take consolidation before we get the final, puke. And then you want to look at maybe buying some of the stocks you like.
Yeah. I didn't think we could go down hard before I thought we were going to be in a holding pattern for the next couple of hours until NVIDIA earnings. So I'm surprised that today, I know the play this week has been to sell the rallies, but from where we were, we came off a lot. I think it feels like.
We're definitely in a more volatile period in the market than certainly a month or 2 months ago. So, which is nice to see because that makes trading just, I think, more enticing, richer opportunities. It's great.
For sure. Well, Tim, I really do. I appreciate you so much. And I appreciate everyone coming on this call. And if anyone has questions, you could call in, email in, askavino@adamesh.com. I know he's on this call. Call 212-774-5983. And enjoy the service. All right. Thanks, Tim. Be good.
Thanks, Adam. I'm getting that register on my computer. I love that thing.
All right. Later. Bye.
Take care. Bye-bye.